We have been ripped off for decades by nearly every country on earth, and we will not let that happen any longer.
When you hear that countries like China and Japan own a massive chunk of US debt, it might sound alarming. Does it give them control over the US? Why do they even invest in US debt? And what happens if they start selling it off? These are big questions, and the answers have far-reaching economic and geopolitical implications. Let's break it down in simple terms. The US government needs money to fund everything from infrastructure to military spending. When it needs funds, it issues Treasury securities, basically IOUs, that promise to pay back the borrowed amount with interest. These securities are considered one of the safest investments in the world, so countries, banks, and investors buy them as a way to store and grow their wealth. One major reason is safety. The US has a long history of paying its debts, and the US dollar is the world's dominant reserve currency. That means US debt is one of the most reliable investments out there. Another reason is economic stability. Countries that trade a lot with the US end up accumulating large amounts of US dollars. Instead of letting that cash sit idle, they invest it in US Treasuries, earning interest while keeping their own currencies stable. There is also a strategic aspect. Holding US debt strengthens economic ties and political relationships, making countries more interconnected. Recently, something unusual happened. Between November 2024 and January 2025, countries around the world sold off a staggering $319 billion in US Treasury securities. This wasn't just a minor adjustment. This was a significant shift in global investment strategy.
On average, the European Union, China, Brazil, India, Mexico, and Canada, have you heard of them? And countless other nations charge us tremendously higher tariffs than we charge them. It's very unfair. India charges us auto tariffs higher than 100%. China's average tariff on our products is twice what we charge them, and South Korea's average tariff is 4 times higher. Think of that, 4 times higher.
Who were the biggest sellers? Brazil led the way, offloading around $55.9 billion. Ireland followed, cutting its holdings by $42 billion. The Cayman Islands reduced its share by $41.2 billion, while Canada, Norway, and India also made substantial reductions. So why did this happen? One major factor is rising interest rates. As US interest rates increase, older treasuries with lower yields become less attractive, leading investors to sell. Currency market volatility has also played a role. As exchange rates fluctuate, central banks adjust their reserves to reduce their exposure to dollar-based assets. Another big issue, geopolitical tensions. The world has changed dramatically since the Russia-Ukraine conflict, and tensions between the US and China have made many countries nervous. There is a growing fear that the US could use its financial system as a weapon, freezing assets or imposing sanctions on countries it disagrees with. To hedge against these risks, nations are diversifying, turning to alternatives like gold and euros. And then there is the elephant in the room, US debt itself. America's budget deficits keep growing and national debt has reached record levels. With President Donald Trump re-elected in January 2025, many countries are worried about another round of fiscal and trade policy upheaval. If you are finding this insight valuable, hit that like button and share this video. It really helps.
Among my very highest priorities is to rescue our economy and get dramatic and immediate relief to working families. As you know, we inherited from the last administration an economic catastrophe and an inflation nightmare. Their policies drove up energy prices, pushed up grocery costs, and drove the necessities of life out of reach for millions and millions of Americans. They've never had anything like it. We suffered the worst inflation in 48 years, but perhaps even in the history of our country. They're not sure. As president, I'm fighting every day to reverse this damage and make America affordable again.
President Trump's return has fueled even more caution among international investors. His America First policies focus on protectionism and unilateral decisions, prompting foreign governments to reconsider how much US debt they want to hold. During his first term, his aggressive trade policies and sanctions alarmed allies and rivals alike. Now, with the expectation of more of the same or even harsher measures, many countries are taking preemptive action to limit their exposure. One of the biggest moves under Trump's administration this time around, the introduction of new reciprocal tariffs set to take effect on April 2, 2025. The idea is simple. If a country has higher tariffs on US goods, the US will impose the same tariffs on imports from that country. Sounds fair, right? Well, not everyone is happy about it. While these tariffs are meant to protect American industries, they come with consequences. Higher tariffs mean higher costs for imported materials, which could lead to price hikes for consumers. Federal Reserve Chair Jerome Powell has already warned that these policies might delay efforts to bring down inflation. The global response has been swift. The European Union has criticized the tariffs, calling them a threat to global trade, and is preparing to retaliate. China has already announced counter tariffs on US agricultural products and is looking at non-tariff barriers that could hurt American businesses. Canada, in response, is considering counter tariffs of its own and has even triggered an early parliamentary election to deal with the economic fallout. The agricultural sector is one of the hardest hit. The US exports a huge amount of agricultural products to China and Europe. If tariffs make these goods more expensive, demand could drop, leaving American farmers with surplus crops and lower prices. Another vulnerable industry is automotive manufacturing. US car makers rely on global supply chains, meaning higher tariffs on imported parts will drive up production costs. That could lead to higher car prices, lower consumer demand, and even job losses in key manufacturing states. The massive sell-off of US Treasuries, combined with the trade tensions brought on by new tariffs, is reshaping global economic relations. Countries are reassessing their financial strategies, shifting their investments, and preparing for a more unpredictable future. The next few months will be crucial in determining how these changes impact the global economy and whether the US can maintain its role as the go-to safe haven for investors. Now here is where you comment. What do you think? Are these moves by the US a smart long-term strategy, or could they backfire? Drop a comment below and let's discuss. If you made it this far, you're awesome. Don't forget to like this video, subscribe to the channel and ring the notification bell so you never miss an update. Thanks for watching and see you in the next one.